Okay, so moving right along here, we also have the foreign tax credit. What did I do with my marker? There it is. All right, so as I had mentioned, you know, at the beginning class, there are a couple of choices with regard to foreign taxes paid. You can put them on the Schedule A as a deduction, or you could take the foreign tax credit, and this is the credit is usually going to be a better deal. This helps to reduce double taxation. It doesn't necessarily eliminate it entirely. You're gonna pay taxes at whatever the highest rate is. Like, so that example before where I had of England, if you're paying a 40% tax rate in England, the US is not gonna give you a credit for a 40% tax rate. They're gonna give you a credit at the US tax rates. So if your US tax rate is 22%, you're gonna get a credit for that amount on the US side, but you're still gonna have to pay that 40% tax on the England side. So here is the calculation for figuring out what that credit is. So you take your foreign source taxable income, everything from abroad, and then divide it by your worldwide taxable income. So everything, so including your US income. Multiply it by the US income tax liability before the foreign tax credit, and this gets you to your foreign tax credit limitation. So the amount so let's look at an example of how this works. So Kim reported worldwide taxable income of $84,010. This included $1,000 of foreign source income. So if we look at this, so foreign source income, 1,000 divided by 84,010. So there's our worldwide income. U.S. tax liability was $18,273. Again, U.S. income tax liability before the foreign tax credit. She paid foreign taxes of $250 of the foreign income, but according to this calculation, she's going to be entitled to a $218 foreign tax credit. So this limitation is even if so in this case, she paid $250 of taxes. This means that her tax rate in the foreign country is higher than it is here. The fact that this is more than this, but she's not going to get a credit for the full amount. She's only going to get a credit at the amount of the U.S. taxes. So, excuse me. So 1,000 divided by 84,010. So that's like 1.2% is what this proportion ends up being. And then you multiply it by 18,273. So $217.51. Foreign tax credit limit. So let's look at let's make some other example up. Let's just say we had, let's say we paid $727 in foreign taxes. And we had, our foreign source taxable income was $5,000. And our worldwide taxable income, which includes this, so we're looking at the proportion of our total income that is foreign source, essentially. So let's say 103,000. And our U.S. income tax liability before taking into account the foreign tax credit, we do that calculation first, is so 103,000, $13,500. All right, so let's look at our limitation. This is our limit. So we've got 5,000 divided by 103,000. So 4.8%. times 13,500, 655. Yeah, 655 is our foreign tax credit limit. So of that, what this is saying is of that $5,000 of that $13,500 of total tax liability that we're paying to the US, 655 of it is attributable to foreign source income. So they're gonna give us a credit for that 655. We paid 727 in foreign tax. We're gonna have to do the limit. Now, if it was, let's just say, this was 7,000. Times 103. Whoops, divided by 6.7%. 13,500. So $917. So $917 of that 13,500 is attributable to our foreign source income. This is going to be our foreign tax credit, because we can't get a credit for more than what we actually paid, right? So that means essentially that we're paying more in tax on that foreign income in the US than we did at the foreign source, right? So whatever that limitation is, so the smaller of these two, the foreign tax paid or the limitation, that's the credit that you get. Let's see. Yeah, they talk about here, you can take it as an itemized deduction instead of a credit. However, it's usually better to take it as a credit. Couple of instances where it might be better. Taxpayer has income from one country on which tax was paid and an equal loss from another country. The net foreign taxable income would be 0. The taxpayer would receive no credit. That would be one instance. Another relates to foreign taxes not based on income, so property taxes. Taxpayers can take these foreign taxes as a deduction for the because the foreign tax credit is available only for based on income. So again, this is only for income, foreign income. So like I said, property taxes, if you have property overseas and you're paying property taxes on that property, you can take that as a deduction. You can't include it in here because there's no income associated with that tax. That's just out and out theft. Here's the form that is used. It's called the 1116 form. You have to indicate what kind of income it is. If it's passive income, usually it's like passive income, like dividends and stuff like that. That's normally where you see this the most often, is if you have investments in mutual funds and oftentimes mutual funds will invest in foreign companies, and then they have to pay taxes, and so the investor has to pay their share of the foreign taxes, and you'll see it on the 1099, how much foreign tax was paid. So a lot of times that's where you would actually see this. But so each, again, columns, name of the country or US possession. If it's something like a mutual fund and you just don't know, you can just put various, bunch of different countries. Gross income from sources within the country above. Deduction, I've never used the deductions, but okay. I guess this is, if it's compensation. Yeah, I mean, you can take it for compensation as well, because that's income. And then down here, date that it was paid or accrued. There are some rules where you can take it as a deduction, even if it's accrued, it's not paid yet. Taxes paid in the foreign currency or in US dollars. Generally speaking, you'll do it in US dollars. Make makes life a little bit easier. And then all that whole calculation is done back here. That's about all I have to say about foreign tax credit. Any other questions?